Hi, and welcome back to this week's episode of the Lady Landlords podcast. I am your host, the founder of Lady Landlords, Becky Nova, and I am joined by Timothy Hero today. I am really excited to deep dive into what Timothy does in helping people find non-traditional lending. So, Timothy, thank you so much for being here today. How are you?
I'm good, Becky. How are you?
I'm good. I love the Christmas tree you got going on behind you.
Thank
It
you.
looks fantastic.
Thank you.
So what I would love to kind of start off with today is just share a little bit about yourself and who you are, if you could.
Yeah, so I am a private mortgage broker for non-traditional lenders. Right now, I live in Richmond, Virginia. I'm from South Florida. My main focus is helping rental investors get financing if they can't go the traditional bank route. These lenders offer fewer docs needed, 30-year fixed mortgages, and that sort of thing. So I connect investors to lenders that work best for their situation.
Gotcha. I know a lot of our listeners are going to be really interested in
Mhm.
hearing a little bit more about that criteria because there are so many people in situations where they really need to kind of get outside of traditional lending. But
Right.
I would love to hear how you even got into this job. How did you even find this role?
It was actually by accident. So before all this, I was a what I call a failed realtor in 2017. I moved from South Florida to Richmond. I spent all my money moving up here. So when I became a realtor, I had no money for marketing. I had some family, but they lived, 30, 40 minutes away, and there weren't enough leads coming in or anything like that. So after 17 months, I never sold a single house, but I knew so
Wow.
much about real estate being around it since I was young. I knew where the money was. I knew where my passion was. So I knew I wanted to stay somewhere in real estate. So I went back to work in a bunch of retail jobs and that sort of thing for a couple of years. And I decided since I love math, I love numbers, I was going to look into becoming a loan officer. And since I was coming from attempting to sell real estate and dealing with real estate brokers, I went on Google and instead of typing become a loan officer, I mixed loan officer with broker and came across
Mhm.
loan broker. And at first I thought, it's not a legit thing, it's not a real thing. But I read into it, I learned about it. I started connecting with investors. When I joined the industry, I was actually messaging 300 to 500 investors a day to market myself. I did this for about a month. And my third month in the industry, I closed 2 deals and I quit my 9 to 5 instantly. I saw it was legit. The rest is history.
Oh, that's great. One thing that you said in there I wanted to ask about was you said that you were around real estate a lot when you were a child. How did
Right.
that play out?
So my mom and stepfather, they got together when I was 12 years old and they remodeled homes still to this day. So while they don't flip homes themselves, they work for flippers and remodel the homes for homeowners for their personal residence, flip properties, you name it. So I was always going to job sites and learning that side of it. And
Mhm.
even growing up, I spent a lot of time looking at luxury homes and learning the financial markets. It's something that I've always had a passion for, and I've always stuck with real estate since I was 12 years old.
That's great that it's really kind of prepared you for then where
Mhm.
you are today. You
Yeah,
didn't know it back at the time, but it's
no,
interesting that all these little different things, either seeing then what your parents were doing, then being a realtor and working in that industry and kind of getting to know the ins and outs of the industry has really put you in such a place to set you up for success now.
yeah. It really has. It was a bunch of stepping stones. Even when I first joined the mortgage side, I closed those 2 deals, and then the next month I think I only closed one, but it was a stepping stone to get to where I am now. So it's all in
Yeah.
progress.
And can you talk a little bit more about then where you are now?
Yeah. So right now, here we are at the end of the year, projected to do about 18 million this year in mortgages.
Mhm.
Some deals might get delayed till January just because the holidays is part of the game. I have a full-time assistant, and we're projecting 50 million next year, which is a huge thing because I joined the industry in the fourth quarter of 2019.
Mhm.
And I only worked a few months in 2020 because of COVID. I mean, COVID shut the whole
Yeah.
market down for 4 months. And then when the market opened back up, for the first 2 months, it was hard to get anybody approved because lenders had higher credit requirements. Since these loans are based on the cash flow of the property, rates were so high that people couldn't get the max LTV because they didn't cash flow at 7%. So I really only worked a couple months last year. So 2021 was my first full year in the business with no distractions. So to hit 18 million was a huge milestone. So
Yes, that is huge, Timothy. You should be really proud of the fact of what you've built in such a short time too.
thank you.
That's really fantastic. What would you say would be the key to your success over this past year?
I definitely got to put it, networking has been everything.
Mhm.
But I think remaining loyal. I see a lot of brokers charging, a very high fee to assist with loans. I've always kept my fees low to put myself in the investor's shoes to really show that I'm in their corner to save them on cost while still finding them the best lender.
Mhm.
And letting them know when they have their best deal or not. Like I have a lot of repeat clients and they keep coming back to me because I delivered what I promised. This is an industry where a lot of people will lie to you to get your foot in the door. So you start the process, and then later on they hit you with the reality of the terms and things change, and they hope you'll stay in the deal. I've never put my clients in a situation like that. So I think my obsession with networking and my loyalty has been a huge part of it.
And from our side as the investors, trust me when I say that we also want to find somebody that we can be loyal to. We
Yeah,
don't want to, every time we do a deal, to have to say, oh, well, now we need a new realtor, and now I need a new lender, and now I
right.
need a new attorney. We want to make sure to find people that we can have repeat business with. So it
Yeah,
sounds like you're really setting yourself up for success in that way of saying that this is kind of a key value for how you like to work with people. So I really appreciate that.
yeah, yeah.
So can you walk us through a little bit of the differences between your mortgage broker with traditional lending
Mhm.
versus then you as a mortgage broker with non-traditional lending?
Okay, so for the traditional side, most of them to even get a quote, you often have to do an application. Um, some will even want to run credit. On the non-traditional side, they don't even run credit unless you decide to move forward with the deal. Um, on the non-traditional side, there's a lot fewer docs to collect. This is a newer industry that many may not know about. Most of this was created in 2014, the non-QM sector. Um, there's no income statements. There's no tax returns. There's none of that. There's no DTI check. It's solely based on credit score and the cash flow of the property. So any income thing isn't looked upon in this industry. Whereas the conventional side, it's 2 years tax returns, your monthly
Mhm.
bills and debt, and it's a lot easier of a process. And because of this, we're able to close quicker too.
Gotcha. So would a lot of the people that come to you be people that either are self-employed,
Mhm.
that maybe don't have high income, or maybe they have high debt to income ratio? Like, what are the trends of the people that are typically finding you that can best use your services?
I would say about 50% of borrowers who come to the non-traditional side are self-employed. And I'd say the other 50% is a mixture of people who might work a W-2, but don't want the loans on their credit. And the non-traditional side, they're not reported on credit. So there's no max of mortgages. I can close 30 mortgages with the same borrower in a year if I wanted to, if they wanted to. Um, so those two things, and we also lend to LLCs. Most banks won't do that. I believe some credit unions will, but most conventional banks won't. So lending to LLCs, not reporting on credit, qualifying self-employed people. Those are the three major factors, and there's no limit to mortgages. Whereas conventional, you're maxed at 10.
I like that. That's
Yeah.
something I feel like people don't really think about is what are we going to do after when we kind of hit that max if they really
Right.
are expecting to grow a larger portfolio. So it's
Mhm.
really great to know that working with you that they can actually make it past that 10,
Mhm.
and also that this is not affecting their credit or then their debt to
Right.
income ratio in case they need a traditional lending for some type of other purpose. So,
Yeah.
so when people do come to you then, since there isn't the same application process as it would be for a conventional loan, what types of information do you try to collect during that first phone call with somebody?
So the main thing is credit score. We just need at least a 620. 700 and higher gets you the best terms. Most lenders top tier is 740 or 760. So we need credit score. We need address to do some research on the property to make sure it's not too rural. Um, and then we need to see the numbers for cash flow. We need the value of it, the rent amount, taxes, insurance. We need to see the cash flow numbers. And that's honestly enough to determine the approval process. We then
Okay.
send over a quote, and if those numbers work for them, they send over an application, which is much, much shorter than conventional. I mean, some of my lenders got one-page applications, and it's 3 minutes to complete. So we pull credit one time, we pull it in the beginning, and it doesn't
Mhm.
get pulled again. Like most conventional route, we'll pull it at the end again. Private lenders, credit's good for 90 days, and it usually doesn't take 90 days to close a loan. So we just closed a 6 property portfolio in 4 weeks flat. So 90 days is when credit expires, but we usually don't have to pull it a second time. So that's usually how the process is for that.
Gotcha. You had mentioned in there that you have to make sure that the property isn't too rural. So
Mhm.
can you tell me a little bit more about that?
Yeah, so they base it on population density. There's sometimes where somebody sends me an address and I tell them, I don't think this will work because it's a town of 8,000 people. Um, and I'll send it to my list of lenders and comes back, one of my lenders will do it, but maybe they'll just reduce LTV by 5%. So if this person wanted to cash out 75, they'll be maxed at 70, but nobody else in the industry will touch it. So to get 70% cash out on a 30-year fix, not reported on credit, is better than what I had thought would have happened. So
So
they,
just out of curiosity, why is it that, kind of these lower population areas are looked upon differently?
I think the main reason is if a tenant moves out or stops paying and gets evicted, they view it as more of a risk of a sitting property that won't be easily occupied. Whereas if you're in a big town like Dallas, Texas, the property hits the market within 3 days, 50 people have applied for it. So
As
uh,
a New Yorker, I definitely understand that. We
yeah,
can rent places, 2 days before the end of the month. People
yeah,
don't even look earlier than that. You just wait till the
yeah.
very end. And our vacancy rates are very low. So, okay, that definitely makes sense. And then also some other things that I've heard in that same category is about properties not being enough money. Do you have a cap that you only lend if a property is worth at least a certain amount?
Yeah, so it every lender has their different criteria, but for the most part, they're in the same range. They don't want to go under $100,000 property value if it's a single asset. If you're doing a portfolio, I can go all the way down to 50,000 a unit. So a four
50,000 a
unit,
unit if
yeah.
it's a portfolio loan.
Yeah, so a 4 unit would need to be $200,000. That sort of thing. In terms of the max on the other side, there's no max. So we can do
Okay.
$4 million properties. Once you go over a loan amount of 2 million, they typically have to go to a committee and get approved. But if the person's
Mhm.
got good credit, it cash flows, it's in a healthy market. I've never had one decline.
Okay. And then you had also mentioned about needing the address then
Mhm.
to get that approval. So
Mhm.
I can see some people kind of being in a situation where they, one, need the pre-approval to kind of
Right,
get the property. But then on the other hand, in order to get the pre-approval, you would need the address.
right.
So how do people kind of end up in that situation where it's kind of the chicken or the egg?
So for the pre-approval side, on the purchase side, if somebody comes to me and they're like, I want to write an offer on this property, but my realtor wants me to have a pre-approval before I waste anybody's time, um, they can complete a quick sheet and I can send it over to my lenders and I can have one lender pull credit if the borrower approves, and then we can get a pre-approval. In this industry, it's very fast. I get pre-approvals in 30 to 60 minutes. So it's very quick, assuming it's not too late in the day or something. But yeah, we'll just run credit and then we'll go off their property numbers that they believe. So if they tell us, I want to buy this property for 200, I believe it'll rent for 17. That's a decent cash flowing property. So that part's taken care of. Now, if they pass the credit thing, we can give them a pre-approval.
So now when talking about that cash flow,
Mhm.
so how do you really verify what those rents would actually be to analyze if the property would cash flow, since that's really what you're lending on?
Right. So the first step is we go off their hypothetical of I think it'll rent for this, their theory. As they move forward on the deal, whether it's a refi or a purchase, we send out an appraiser, and the appraiser gives a market rent. Lenders usually go off the lower of the two. If somebody tells us, I think the property will rent for 2,000 a month, I want to buy it. If the appraiser goes out there and says, no, it's a $1,700 a month property, lenders are going to go off that 1,700. Now, some lenders will do a hybrid model and take the middle number of the two. But I always tell people to be safe. Let's assume it goes off the lower amount. What do you think it would rent for?
Gotcha, which is really smart. So, okay, so it's really the appraiser that's making the determination about
Right.
what that rent would actually be. And
Right.
then are there any other numbers or anything else that you factor in to the property being cash flowing besides then your rents?
Yeah, taxes and insurance.
Okay.
Taxes or insurance is something we usually don't know the exact number on until the property's been back from appraisal and everything. That usually gets taken care of midway of the deal, sometimes towards the end. It's not too often taxes ruin the cash flow of a deal, but Texas can be pretty high property taxes. Um,
As I
Illinois
say, in
is
New
very,
York, they might.
yeah,
That
Illinois
might
is
be
very
something.
high. You throughout the country, it's very common to see 1.25% of the value for taxes. Colorado has some of the lowest in the country. Illinois has some of the highest. Illinois, you can very often pay 2% a year in taxes. So a $400,000 property, you can pay $8,000 a year in property taxes. So it's very important that people come to us with reasonable numbers. I have people who come to me and the taxes seem a little too low. I mean, I've had people come to me with houses near me, and a $300,000 home isn't going to have property taxes of 700 a year. That doesn't add up. So it's very good to be reasonable upfront. That way, we're working with real numbers, because we're going to find out the real numbers before closing. And you don't want to find out at the end we had to reduce the loan amount because it doesn't cash flow because those numbers came in much higher.
And then really people would be doing themselves a disservice if they're
Right.
not actually giving you the numbers. If they come to you and they say, hey, I've got an 800 credit score, the rent, the property is $150,000, but hey, it rents for $5,000 a month,
Yeah.
and oh, the taxes are $50, right? Like you'd be like, yeah, of course I can lend on that. But when it
Yeah.
then comes down to closing, it's just not going to work, because
Right.
you're going to find out. There's no way
Yeah.
that you're not doing your due diligence, so that because somebody tells you these things that you're going to lend just based on that information. You're going to
Right.
find out. So it's
Yeah.
really in everybody's best interest to give the right numbers. And we understand maybe not everything is perfect and exact and very clear at the very beginning,
Yeah.
but we really do want to use our best guesses here. It
Yeah.
sounds
Yeah.
good.
It's okay to be off by a little bit. If you tell me your property taxes are 1,200 a year and it comes in at 1,350, it's $150 difference spread out over a year. It's a little more than
That's 10
$10 a
bucks.
month. Yeah. That's fine. But if you say it's 1,200 and it comes back at 2,100, now we're talking difference in cash flow. So
Yes. And then with that cash flow, is there a certain amount of cash flow that you would require? Would you be
yeah.
like, great, this property makes $1. Here's your loan.
So lenders have a DSCR, debt service coverage ratio. Every lender requires a different amount. Most lenders right now is 1.1 or 1.2, which means we want to see a cash flow of at least 10% more than what the mortgage will be. And that mortgage is covering everything, the principal, interest, taxes, everything. If your mortgage is $1,000 a month with everything included, we want to see the property rents for at least 1,100. If it does, then you'll be able to get the max LTV. That's the approval side. We need not only a property that rents to cover the mortgage, but also a little left over.
Gotcha. And then also, so that also would take into consideration what the down payment somebody would be making would be. right?
Correct. Yeah, because if somebody has a property that only meets that 1.1 DSCR, if it's 70% loan to value, then that means the most we can lend is 70%. So they got to put 30% down versus the 20. So the cash flow determines the max LTV you can get.
Gotcha. So let's talk about that for a second. Down payments.
Mhm,
Do you, in all situations, require some skin in the game
mhm.
from an investor?
Yeah, it's 20 to 25%, assuming no cash flow issues. Yeah.
Gotcha. What is your opinion when you hear other lenders kind of saying, oh, I could give you 100%. Oh, there's this. Like, what does that kind of raise for you?
I'll say this. If those lenders were legit, my lenders wouldn't be in business. Because
Right?
if my lenders only lend 80% and the people next door lend 100, my people wouldn't be doing 500 million a year in mortgages. So
Right.
maybe you could find an individual investor that's willing to loan 100%. But as of right now, as we speak, there's no actual company that does it. Most of these lenders, they get their money from the same capital partners oftentimes. If you put 20 companies in a room, they probably share the same 3 or 4 capital partners. And the capital partners are the ones who make the rules. So unless these 100% lenders have their own capital partners that nobody knows about, I don't find it to be true.
And there's usually not too many people out there with like millions of dollars
Right.
that nobody knows about, right? Or that are not doing anything with it. Yes, you
Yeah.
can absolutely find then that private lender or somebody in that situation that might be a kind of one-off. But
Yeah, an
once again,
individual investor.
there's not kind of the individual investors, yes, but you're not exactly, there's not banks, there's not
No.
lenders out there being like, yes, we will give you 100% of this. They really need you to kind of have that skin in the game. So that's why it's perfectly reasonable that you and other lenders are looking for that 20-25%. But I hear that you're also saying in certain situations, in order to make the numbers work, an investor might have to put in a little bit more money to
Mhm.
get to that DSCR, correct?
Right. Right. And that depends on the market. Like I don't do deals in California. I can, but they often don't cash flow well enough. I've had people come to me with $600,000 homes, which is very cheap in California,
Yeah.
$600,000 homes, and it only rents for like 2,800 a month. That the max loan you can do on that's like 55, 60% LTV. So that really determines everything. So it depends on the market. For the most part, especially because we're in a market where rents are high, very high. There's no supply, but there's so much demand. But right now, we're not seeing too much of a cash flow issue because the LTV, we need low rates to give a better cash flow, and we need high rents to help. And right now, we have both of those. So there's
Mhm.
not too much cash flow issues restricting LTV right now.
You've used the acronym a couple times, LTV. Can you describe for some of our listeners that might not be familiar what that means?
Yeah, so that just means loan to value. It's very important to realize on the purchase side, it stays LTV as loan to value because a lot of people come to me and they're like, I'm buying a property for 200,000. I see you do 80% loan to value, but I'm buying a $200,000 property that's worth 300. So will you loan 80% of the 300? Lenders are always going to view the value as the lesser amount. If you're buying a $300,000 property for 200, they're going to view it as a $200,000 property and give you 80% of that, which would be 160. If you're buying a $200,000 property, but it's worth 100 and it appraises for 100, they're going to give you 80% of the 100. So they're always going to go off the lower of the two to protect themselves. But LTV just means loan to value.
Perfect. Thank you very much. That's gonna be really helpful for some of our newer investors out there when kind of looking into that. So got it. So now you have people that are coming to you that maybe don't have the traditional W-2, or they do, but they don't want this to show up on then their credit, or they've
Right.
already hit their tax portfolios. They're coming to you, they have that address, they're able to kind of share those numbers with you as best and most accurate as they kind of can. And then you're really looking for what that cash flow is going to be on that property. You mentioned closing costs before that. Sorry, you mentioned closing time before. What would you say is your average turnaround time to get a loan closed?
So that, especially in today's market, varies very wildly, because if somebody comes to me with a single asset, just wants to do a single property refinance, and let's say a popular city like Tampa, Florida,
Mhm.
we can close that in 3.5 weeks, assuming, no holidays, the appraisal's done decent, time frame. Um, Whereas somebody who comes to me with a portfolio in a semi-rural town where there's only 18 appraisers in the whole town, we're gonna spend 3 or 4 weeks just waiting on appraisals because the market they're in. And now we're waiting on 15 or 20 appraisals because it's a portfolio. So single asset loans are typically 3.5 to 4 weeks, but if you're not in a very big market, it can be 5 weeks. In terms of portfolio, depends on the market you're in and how many properties you're doing. Those are typically 5 to 6 weeks, can be up to 8 if it's a big portfolio
Mhm.
in a semi-rural market. Um, but overall, I'd say for 4 weeks or so for a single asset.
And which means then much, much faster also than traditional lending.
Yeah, I've had people come to me, and private sector right now has gone down so much in rates, especially with the traditional lending's 7% rule. Um, we're pretty close to conventional these days in rates. Before COVID, conventional was always like a full percent lower. I have cash out
Mhm.
refis that I quote at 4.5%, and the bank will quote my client at 4.3. So we're only 20 basis points higher. We're not on your credit. It's easier approval. It's quicker. Why not just go that route? But I have people who will say, I decided to go conventional, and no hard feelings. You got to do what's best. And 2.5 months goes by and they come back and they're like, yeah, we still haven't closed that. I just want to do it with you. Let's move forward. And I'm like,
Interesting.
no disrespect, but I forgot about your deal overall. I thought that had been closed. That was 2.5 months ago. So yeah, conventional can take forever.
Yes, 100%. There's so many different little things that can kind of get in the way. And as we're
Mhm.
talking about earlier in the episode, there's so much of that paperwork and so many things. I
Yes.
mean, I think all of us that have bought properties, there's nothing worse when you're like, okay, we're supposed to be closing tomorrow. And then you get that dreaded email from your mortgage broker being like, hey, can you send me your credit card statement again
Yeah.
from last month? Oh, I also need this credit card, or I need that savings account. And you're just like, we've gone through all this. Like, I've sent you my firstborn. Like, what do you mean you still need that one more credit card statement, or
Yeah.
that one more thing? And once again, it sounds like this really just alleviates all of that extra stress, or that just paperwork that needs to be kind of sent back and forth, which saves everybody a lot of time and energy. So I
Yeah.
like hearing that. um so I know you had mentioned then, with getting that appraisal is really so important for
Right.
this type of lending. So
Mhm.
that's a fee that then the buyer would have to then pay for. What other fees are included in these types of loans that may be different than traditional lending?
Yeah. So every lender in this private space usually has the same fee. It's just a different amount. Um, they all have an underwriting fee. If you're doing a single
Mhm.
asset, this underwriting fee can range from 1,200 to 1,600 per property. If you're doing a portfolio loan, it's usually discounted. Like you'll pay the full price for one property, and then every property after that is maybe like half the fee. So you save a lot in fees there. So there's the underwriting. There is prepaying escrow and taxes for a year. They all require that, the same thing. Then there's the origination. The origination, a lot of people don't know this, is actually optional. Most do
Mhm.
1% origination because every origination point you buy, typically in this market right now we're in, is worth 0.5% on the rate. So if I quote you 5% on the rate, no origination, you're saving up front. But if you do one origination point, it knocks it all the way down to 4.5% on the rate. So
Ah.
the origination can vary. You can buy it all the way down to like 4 origination points, or you can pay no origination points. So that is really dependent on what you as the investor want to do. So there's that. There's the underwriting. There's a broker involved. Typically, a broker fee is 1 to 2%. I usually just charge a flat 1%.
Mhm.
Going back to what we stated about being in their corner and helping with fees. Then there's the prepay. Um, if you're doing a refinance, cash out, all these fees come out of the loan. So you don't have to come to the table. The only thing you would pay out of pocket is the appraisal. And sometimes, depending on the lender, they require a $90 appraisal review fee. Those are the only out of
But
pocket.
$90, I think,
Yeah.
I think if you're kind of in this game, right, and you're putting your 20% down, I think that $90 is rather reasonable compared to
Yeah.
some of those other fees that we get during loans. So
Yeah.
I think that one, I think most of us would be able to handle, right?
Yeah, I hope so, because you need to show 6 to 12 months reserves that you can make 6 to 12 months of the monthly payment if your tenant moves out. So I hope you have the 90 to cover that.
Okay, so that's interesting. So a 6 to 12 months. So how does it gonna get determined if it's gonna be closer to the 6 side or the 12 side?
So it depends on the lender.
Okay,
Sometimes lenders will even do like a, dare I say, one-off scenario where if somebody comes to us and they got a lower credit score, mid 600s, this lender might usually require 6 months reserves, but to approve their deal with a good LTV and everything, they might say, if you want the best terms, we are going to want 12 months to make sure you have the money, that there will be no default.
smart.
And when it comes to reserves, it's actually easier than most would expect. 95% of my deals never have a problem with reserves. So you only need 6 or 12 months, depending on the lender, of the monthly payments. So if it's $1,000 a month mortgage, you need either 6,000 or 12,000. But a lot of people think that has to be sitting in the bank. It can be in stocks, it can be in retirement account, it can be in all these different things. So, and unlike conventional, it's not audited. Like you could have borrowed it from a family member 4 months ago. We're not going to ask you, is this $8,000 yours though? It's not something that is audited. We see it's in your account, your name's on the statement, you got the reserves, on to the next thing.
Gotcha. And then that's really something that if you so then choose to give it back to that family member the day after closing,
Which
and then
happens.
you can't make your mortgage, then
Right.
that's kind of that's a you thing.
Yeah,
That's under
that's
your
you.
responsibility.
Right.
Gotcha. And then if somebody in that case, once again, hopefully this isn't the situation, if somebody then defaults on that, is that kind of go through then your typical foreclosure, or is that process different if somebody defaults on their mortgage?
So surprisingly, none of my clients have defaulted, at least to the best of my
Okay.
knowledge, so far, right? But
Uh-huh.
so the way it works is they can only legally go after what they're owed. A lot of people are like, is it a non-recourse or a recourse? And I don't want them coming after my personal residence if I default. They can't go after more than what they're owed. And since these lenders, let's say on the refi side where we're capped at 75%,
Mhm.
um, if you do a 75% loan on, let's say, a $200,000 property, so it's a $150,000 loan. If they seize that property, that $200,000 property, and sell it,
Mhm.
they can only walk with what they're owed. You get the difference. So a lot of people think they'll lose their whole portfolio over one property. They can't go after more than what they're owed.
I like that because then it sounds like, okay, I owe you $100,000. You sell my $200,000 house for me, and then you give me my money.
Yeah,
So,
it's almost a realtor for them.
yeah, if you're in a bad situation, it actually sounds like this is almost helpful to you. Clearly
Yeah,
not the situation you want to be in, but okay, but that's
yeah,
actually then really helpful to know. Um, but okay, I like the idea that with those reserves that it can come from a friend, that it's not something that needs to be that seasoned money. It's not as kind of strict. And is that a new requirement due to the pandemic, or is that something that you've seen
no, so
traditionally, even in 2019?
yeah, so before the pandemic, 90% of the industry only required 6 months. Once the
Okay.
pandemic happened, most of my lenders now require 12. Um, I think I only have one that requires 6, actually. Most do 12. But
Okay.
if you borrow the money from a friend or something, put into your account, if they see you put a large amount in the past week just to meet the reserves requirement, they might ask for a letter of explanation, but it's not something
Mhm.
they dig into. You can just say, I borrowed it from somebody, or it was payback from an investment, or something like that. It's not audited. It's a lot more relaxed industry.
Gotcha. I like that. I feel like this is really going to be an opportunity for so many of our listeners to be able to go after that rental property that they've been looking for, but have
Yeah.
not been able to kind of go through traditional. So, what would you say is the most typical area that people are looking for loans in right now?
In terms of city,
Yeah.
so since I do it in 45 states, right now my biggest market is Richmond, Virginia, and Charlotte, North Carolina. Um,
Okay.
I made my mark when I first joined the industry. My first like 7 deals were in Texas. That's where I was marketing to. It's a big state.
Huh.
It's a pretty good cash flowing area. Um, so Houston, San Antonio, Atlanta, Tampa, Richmond, and Charlotte are my main markets. But as you see on the reports, Idaho has had the highest appreciation. So I'm sure there's a lot of cash outs going on in Idaho right now. But those are my main markets right now.
Interesting. I'm not surprised to hear Charlotte on that list. I think we
Yeah.
both kind of know that that's just been a very hot market lately.
Yeah.
And Idaho, yes, I actually have spoken to somebody recently from Idaho and just talking about property values over there. It's just insane. So that is interesting that you've had so many people coming to you for those cash out refinances and to really be able to use then that equity from their property.
Yeah.
So when somebody comes to you, when you're having that initial conversation with them, what are kind of those like bells that go off on your head that you're like, this is fantastic. This is absolutely the ideal person that I can be able to help?
Well, if somebody comes to me for a quote and they want to explore financing, if they don't really know how the industry works, that's totally fine. That's a broker's job, is to help and guide them, and also find them the best terms. So if they have questions, they're confused, I'm not turned off by that. I'm fine with that. In terms of the most ideal client and somebody who I'm excited to work with, it's somebody who's responsive. I speak with
Yeah.
a lot of investors. I mean, I probably speak with 150 investors a week, like continuously, not just one, email type of thing. So if it's somebody who wants to move forward, or if it's somebody who comes to me for a quote, completing that quote right away, and if I ask any questions about the property, having a reasonable response the same day or something, that lets me know you're valuing my time, because I do a lot of loans. I am very busy. I had to bring on a full-time assistant to help manage the workload. So if I'm going to bust my butt to get you closed in 3 weeks, I want you to value my time and be responsive with sending over docs quickly. I mean, us being able to close faster than conventional is only realistic if the borrower, if the investor is quick as well. So somebody who hustles and moves is my ideal situation.
Gotcha. And I think that's really important too. Like, we are the ones asking for this help. We are the ones asking for this loan. So, and it's perfectly fine if this is something that one of our listeners is new to, that is still saying, hey, I'm going to move forward with this and I need help kind of navigating it. And I love the fact that you are willing to speak to them and have kind of that educational aspect to it and help people walk through it. And as that really is, customer service is such a large part of your job. But it is important that if we're asking for that help, that we do follow through, right? And it's okay if we're not necessarily like 100% like ready to go, or maybe we think we have a property and it ends up not working out, and then we kind of have to start and find another deal, right? We all know kind of properties are getting picked up on the market pretty quick right now. But it's more really what our intent is, right? Our intent is to come in and say, hey, we want to work with you. We need your help. Let's get going on this, and let's really work as a team and as a partnership to kind of get this deal closed. So I hear that. What types of people that on the other side are you not able to help? Who is kind of not your ideal client?
Somebody who is seeking 100%, somebody who comes to me and has no money for reserves, or I don't do rehab loans. So somebody who needs rehab, I can't touch those. I mean, I legally can. It's not an industry I care to be in. It's got a very high fall through rate with deals. So I stay away from the fix and flip stuff.
Okay.
That's typically the main thing, are those two scenarios. Someone who's wanting 100% financing or wanting rehab stuff.
Right. And that makes sense. If you're really, once again, you're lending on the asset and the cash flow that's included in that. So once again, if it's a gut rehab, there is no cash flow.
There's no cash flow.
It can't be rented.
It's costing you $1,000 a month. You're not making anything.
Yeah, it sounds like, once again, if it's livable, if there's renters in there, yes, fine, you have to make some upgrades. That's then on us as the investor to say, okay, you know what, I have to paint, I have to replace this carpet, I have to do those cosmetic things. But really, once again, yes, because once again, your appraiser needs to give you that, what that rent is going to be. So fine, maybe the rent is a little bit lower until we do those upgrades, but that is totally different than doing the BRRRR strategy, the gut renovations, those complete fix and flips.
Yeah.
Is that's not your bread and butter here.
Yeah, and we can do loans on properties that need updating, but not actual rehab, if that makes sense. Like things we won't lend on is if there's roof damage and there's leaking, if there's plumbing issues, electrical issues, those are big red flags that the property isn't habitable. If you want to update the carpet, or if you have a 1970s kitchen and want to update that, those sort of things are fine. Those are your doing if you want to customize. Um, our question is, can we put a renter in there tomorrow and it not be against the law for them to live on the property? There's no caving in roof
That's
or any of that.
kind of key.
Yeah,
So
that's
but what it sounds like then somebody that you could help is somebody that went through maybe a hard money lender, got a rehab loan,
yeah.
then now come to you months later to do that cash out refinance. It sounds
That's
like
a
you can
lot of
help
my
them at that time.
that's a lot of my business. A lot, because before the
Gotcha.
pandemic, I had lenders who had no seasoning period. So somebody could buy a home all cash or however they go about it, rehab it, and if it's a slight rehab, be done in 2 or 3 weeks and instantly refi the cash out with me. Now my lenders are at 3 months seasoning, but I'd say that's 50% of my business are these BRRRR strategy investors.
I love knowing that. And then once again, 3 months is still so much better. That's half the
Yeah.
time as most traditional lenders, which are requiring 6 months seasoning period.
Yeah.
So the fact that you can help investors get their money back out in half the time is absolutely huge. I can see why that's such a draw to you.
Yeah, and we can actually start the process at 2 months and just close it on the 3 month seasoning day. So there's no month
That's
wasted.
perfect. No, there's absolutely no time wasted in that. I'm sure that's actually going to be a big help to a lot of the ladies listening. Is
Yeah.
there anything else that you would say are great people to be able to reach out to you, to work with, or anything else that you want to say about working with non-traditional lenders?
It's such an easier process. I have investors who have been doing this longer than I've been alive. So they've dealt with the traditional side before I was even a thought. And now that this industry in 2014 was formed, the non-QM side, they'll never go back to that even if they qualified. The rates on the non-traditional side are so competitive now that it's almost bank loan. The approval, it's so much less docs, it's quicker, it's not on credit. If there's more than one person on title, let's say two investors come to me, they're both on title, we will actually take the person with the highest credit score and use them for the approval and give them the better rate instead of, where a bank might not do that. So the whole process is easier, not being on your credit, so it doesn't alter your personal DTI. So if you want to buy a car or a house, these loans look like they don't exist. Somebody pulls your credit and it'll show a private mortgage lender pulled your credit however long ago, but nothing else happened after that. So it looks like you applied for a mortgage and then backed out. But in reality, you have the mortgage. It's just not on your credit.
Exactly. It's not showing all of a sudden that extra debt that you have from all those properties as well. So
Right.
that's really helpful. Gotcha. I think that there's going to be a lot more people that are going to want to start looking into non-traditional lending after hearing this episode.
Yeah, it's a very growing industry, very big.
Yes. No, this is incredibly helpful. I think it's going to help a lot of people out there that one are in traditional situations, but just you can offer so many extra benefits to them. And then those other women that are kind of in that position where they can't necessarily go that traditional route and have been pulling their hair out trying to figure out what a solution is. I think you're going to be getting a lot of phone calls. So for any of our listeners, I will make sure to link Timothy's information down in the show notes. So do feel free to reach out to him to see if he can help you with getting a non-traditional mortgage or also doing a refinance. So Timothy, thank you so much for being on this week's episode. I really appreciate you being here today.
Thank you for having me. It was very fun. Hopefully very informative for everybody. We had a good time. Maybe we'll do it again.
Yes, I think we're going to have you back on and kind of then break down some of these loans a little bit more. So We'll definitely schedule a time to do that. For all of our other listeners, please do make sure to click that subscribe button on podcasts or on our YouTube channel so you do not miss the next episode of the Lady Landlords podcast, which comes out every Tuesday. Thanks for listening and see you all next week.